Money. Every day we use it. We work for it, spend it in stores, and save it for the future. It seems like money is something very valuable and limited. But there is one strange question that almost nobody thinks about. Where does money actually come from? At first glance, the answer seems simple. Many people believe that money is created by the government. Some imagine giant printing machines producing endless stacks of banknotes. Others believe that money is backed by gold stored somewhere in secret vaults. And some people assume that the amount of money in the world is strictly limited. But the reality is much more surprising. The truth is that most of the money in the modern world is not printed at all. In fact, the majority of money exists only as numbers in computers. And even more surprising, a large part of that money is created out of thin air. Not from gold, not from taxes, not from printing presses, but from loans. To understand how this works, imagine a very simple situation. A person walks into a bank and deposits 1,000 euros into their bank account. It seems logical to think that the bank simply stores this money safely until the person decides to withdraw it. But banks do not work like simple storage boxes. Instead, banks use something called fractional reserve banking. This means the bank keeps only a small percentage of deposits in reserve. The rest can be used to issue loans to other customers. For example, imagine the reserve requirement is 10%. When you deposit 1,000 euros, the bank keeps 100 euros as reserves. The remaining 900 euros can be lent to someone else. Now something interesting happens. A second person takes a loan of 900 euros from the bank. They spend that money. Maybe they buy a laptop. The seller of the laptop deposits those 900 euros into their own bank account. Now the banking system has a new deposit of 900 euros. And the bank repeats the same process again. 10% is kept as reserves. The rest, 810 euros, can be loaned out again. Then those 810 euros are spent again. They are deposited again. And once again, most of that money is loaned out. This process continues over and over again. The same money moves through the system, creating new deposits and new loans each time. Eventually, the original 1,000 euros can expand into nearly 10,000 euros in total money circulating in the banking system. This process is called the money multiplier, and it is one of the key mechanisms through which modern economies expand their money supply. But this is only the beginning of the story, because something even more surprising happens when banks create loans. When a bank approves a loan for someone, it does not always take money from another customer's deposit. Instead, the bank simply creates new money digitally. Imagine you take out a loan to buy a car worth 20,000 euros. You sign a contract with the bank, and suddenly your bank account shows a new balance, plus 20,000 euros. Before that moment, this money did not exist anywhere in the system. It was not taken from another person's account. It was not printed. It was simply created as a digital entry. The moment the loan is issued, new money appears in the economy. But at the same time, a new debt appears as well. On one side of the balance sheet, there is money. On the other side, there is a loan that must eventually be repaid. This is why people sometimes say that money is actually created from debt. Every time a loan is created, new money enters the system. And every time a loan is repaid, that money effectively disappears again. It is almost like money is constantly being created and destroyed inside the financial system. This may sound strange, but this mechanism is one of the foundations of the modern global economy. In fact, physical cash makes up only a small fraction of the total money supply. In most developed economies, around 90 to 97% of money exists only as digital bank balances. That means when people talk about money, they are mostly talking about numbers stored in databases. Numbers that can move instantly between accounts. Numbers that represent value because everyone agrees that they represent value. Now this raises an important question. If banks can create money through lending, why don't they create unlimited amounts of money? Why don't banks simply make everyone rich? The answer lies in the limitations of the financial system. First, banks are required to follow regulations imposed by central banks and financial authorities. These regulations include reserve requirements, capital requirements, and liquidity rules. Banks must hold a certain amount of safe assets compared to the loans they issue. Second, lending money always involves risk. If borrowers cannot repay their loans, the bank loses money. Too many bad loans can destroy a bank. This is why banks carefully evaluate borrowers before approving loans. Third, the economy itself limits how much lending can occur. People and businesses will only borrow money if they believe they can use it productively. If the economy slows down, demand for loans may fall. But even with these limits, the power to create money through lending gives banks enormous influence over the economy. When banks lend aggressively, money flows into businesses, real estate, and investments. Economic activity accelerates. New companies are created. Jobs appear. Infrastructure is built. But if banks become too aggressive with lending, the result can be dangerous. Sometimes this leads to financial bubbles. A financial bubble occurs when the price of an asset rises rapidly because large amounts of borrowed money are chasing that asset. One famous example happened before the global financial crisis of 2008. During the early 2000s, banks issued massive amounts of mortgage loans. Millions of people borrowed money to buy houses. House prices kept rising. Banks continued issuing more loans because rising prices made everything seem safe. But eventually, many borrowers could no longer afford their mortgage payments. Defaults began to spread. As people stopped paying their loans, banks faced enormous losses. Housing prices collapsed. Financial markets panicked. And the global economy entered one of the worst recessions in modern history. This crisis revealed how deeply the financial system depends on credit-created money. When lending expands quickly, the economy grows. When lending collapses, the economy can shrink rapidly. But commercial banks are not the only institutions capable of creating money. Central banks also play a major role. A central bank is the primary monetary authority of a country or group of countries. For example, the European Central Bank manages the euro. In the United States, the Federal Reserve performs this role. Central banks control monetary policy. They influence interest rates, regulate banks, and manage the supply of money in the economy. One powerful tool central banks use is called quantitative easing. During quantitative easing, the central bank creates new digital money. Then it uses that money to purchase financial assets such as government bonds from banks and investors. These purchases inject new liquidity into the financial system. Banks suddenly have more money available. Interest rates may fall. Lending becomes easier. Investment increases. This process was used on a massive scale after the financial crisis of 2008 and again during the global pandemic. Trillions of dollars were created by central banks to support economies during difficult times. And yet another question appears. If trillions of dollars can be created so quickly, why doesn't this automatically make everyone wealthier? The answer is inflation. When the supply of money grows faster than the supply of goods and services, prices begin to rise. More money competes for the same amount of products. As a result, each unit of money buys slightly less. Inflation is a normal part of modern economies. Most central banks actually aim for moderate inflation, often around 2% per year. But if too much money is created too quickly, inflation can become dangerous. In extreme cases, countries can experience hyperinflation. Hyperinflation occurs when prices rise extremely rapidly. Money loses value so quickly that people try to spend it immediately before it becomes worthless. History provides dramatic examples of this phenomenon. In Germany during the early 1920s, hyperinflation became so severe that workers were paid multiple times per day so they could rush out and buy goods before prices rose again. In Zimbabwe during the late 2000s, inflation reached astronomical levels. Banknotes worth trillions of dollars were printed. Yet they could barely buy basic necessities. These examples demonstrate an important truth. Money only works because people trust it. Money has value because society collectively agrees that it has value. If that trust disappears, the entire monetary system can collapse. In reality, money is not just a physical object. It is a social agreement, a system built on confidence, belief, and shared understanding. This becomes even clearer when we look at the history of money. Thousands of years ago, people used barter systems. Goods were exchanged directly for other goods. But barter was inefficient. It required both parties to want exactly what the other had. Eventually, societies began using commodities as money. Gold, silver, salt, and shells were used as mediums of exchange. Gold became especially important because it was rare, durable, and difficult to produce. Later, banks began storing gold for customers. Instead of carrying heavy gold coins, people could carry paper receipts that represented gold stored in bank vaults. These receipts gradually evolved into paper currency. For a long time, Many currencies were backed by gold reserves. This system was known as the gold standard. Under the gold standard, governments promised that their currency could be exchanged for a fixed amount of gold. But over time, governments abandoned the gold standard. Today, most currencies are fiat currencies. Fiat money is not backed by a physical commodity like gold. Instead, it derives its value from government authority and public trust. Governments declare that the currency must be accepted for payments and taxes. As long as people trust the stability of the system, the currency functions normally. Today, the monetary system is becoming even more digital. Many payments happen electronically. Credit cards, online banking, mobile apps, and digital wallets have replaced physical cash in many situations. When money moves digitally, nothing physical actually travels from place to place. Instead, banks simply update records in their databases. One account decreases, another account increases, and the transaction is complete. Behind these simple digital transactions lies an enormous global financial network. Banks, payment processors, clearing houses, and central banks work together to ensure that trillions of dollars move smoothly through the system every day. Despite its complexity, the entire system depends on one simple foundation: trust. Trust in banks, trust in governments, trust in the stability of the economy, and trust that the numbers displayed in bank accounts represent real value. This leads to a fascinating conclusion. Money is not just paper. It is not just metal. It is not even just digital numbers. Money is an idea that billions of people accept every day. And as long as that idea continues to be believed, the system continues to function. New money continues to be created. Loans continue to expand the economy. And the global financial system keeps moving forward. All built on something surprisingly intangible: trust.